Hi, Jennifer. I wanted to show you a presentation I made for you in order to provide a better, clear overview of your current options. Now, let's have a look here. We have an RBC offer of 3.94%, 4-year fixed rate. And I believe RBC can also offer you a re-advanceable HELOC, meaning the limit goes up as you pay down the principal. We do have 3.99% refinancing options with our lenders. Again, we also have the re-advanceable HELOC options available. Now, and then we're going to present you with an option three with a fixed term that's locked in for 4.44%. And the 5.45% is the HELOC rate with Manulife One. The main account is the HELOC, checking account and savings account all in one. So you can write checks, deposit your payroll deposits, everything just as you would normally do with your checking account, combined into a one single account. So we're going to take a look at the cash flow on a monthly basis, right? So if you were to go with RBC with a 3.94, this is the monthly payment, 35.64. And with our options, it's 3.99%. The monthly payment is slightly higher. We're looking at less than $20 a month difference. And then with the Manulife, we can set up the minimum amount for the fixed portion, which is the sub accounts that we went through in our calculations the other day. But we're setting the minimum as a fixed portion right now. So the monthly payment is just 550. We'll tap into the Manulife one a little bit in more detail later. But this is what you can expect from a fixed monthly expense point of view with all three options. And then the areas of focus, right? When it comes to a mortgage, we want to look at the interest rate. Obviously, is one of the most important factors, but not the only factor that determines the suitability. And then we're going to take a look at menu one option. So interest rate determines monthly payment as well as the total interest cost to you over the term of the mortgage. Fixed rates, they remain unchanged, whether that's a 3-year term you're selecting to go with us, or if you go with a 4-year term with RBC, then that all the rates and terms remain unchanged for 4 years. Whereas if you choose a variable rate, then your rate will float with changes in prime rates. Now, for my personal opinion, if you were to choose a traditional mortgage, whether that be with RBC or through us, I would recommend going with variable rates just because there's more opportunities for rate cuts later this year and the next one happening very soon, coming in June. So and I believe the rates right now for variable rate is very close to our fixed rate terms. So if there is just even one rate cut, we would be breaking even with the fixed rate. So I think this is definitely something to consider, variable rate over fixed rate. And then you also should consider the break fee calculations in case you need to break the mortgage early. If you sell the home, if you're upgrading, if you're upsizing, downsizing, changing the location, or just decide to refinance anytime before your maturity date, then we have to factor in the break fee, right? With variable rate, it's more flexible and cheaper to break. It's just a 3 months interest payment, whereas fixed rate is calculated by the interest rate differential over the remaining terms of the mortgage. So the earlier you break the mortgage, the more penalty you would pay essentially. And then with a conventional mortgage, there's a prepayment privilege. You're typically able to pay up to 15% on the anniversary date of the mortgage. And this goes 100% against the principal balance. Also, with each, if you're depending on the frequency of your mortgage payments, if you're set it up as a monthly payment, then each month as you make a payment and as you pay down the principal balance, your re-advanceable HELOC will go up by that amount. At the same time, if you set it up as a semi-monthly, then your principal is paid down faster and therefore less interest you're paying. So if you're going with a traditional type of mortgage product, then I would recommend going with a more frequent payment schedule rather than a monthly payment because it does make a big difference in terms of the overall interest cost over the life of the mortgage. So with Manulife One, this combines your savings, checking, and mortgage into one account. It's daily interest calculation like we talked about last time. Flexible payments, I think this was one of the main factors or main benefits of going with the Manulife One. So the more you deposit, the more you pay down the balance. So there's never really a need to ensure, oh, you're only making the prepayment on the anniversary date. RBC is very anal about this. You have to ensure you're making that prepayment exactly on the anniversary date. It's the only way you can pay make the payment 100% against the principal. But with Manulife One, every deposit you make into your main account, you're essentially paying down the balance of the mortgage. So the 100% goes into the principal payments. And if you have to skip a payment, there's no problem. Unlike traditional mortgage products, you would be in trouble if you ever missed a payment, and you could be facing foreclosures, and you would definitely take a big hit on your credit score. But with the Manulife One, there's just so much flexibility. Even if you have to go on, obviously you have to make that 550 minimum payment for the fixed portion. This is the re-advanceable HELOC, right? The main account is the re-advanceable HELOC. Limit automatically increases as you make a deposit. So you can make a daily deposit if you're able to. So you can make payments as frequent as you want rather than fixing a fixed time and frequency for your mortgage payments like with a traditional product. Now, I've redone the calculation with the Manulife One calculator. I think what screwed up our calculations last time was we were putting too much expenses for your monthly, so there weren't any savings remaining pretty much to take advantage of the daily interest calculation. So with this scenario that we're saving 107,000, this is based on a $4,000 monthly expenses, not including the mortgage, obviously. It's just 4,000 for your household of just you and your husband with the utilities and all the dining out and everything like we talked about. If we're able to keep your monthly expenses within $4,000, then at minimum you can expect the saving. If you spend less than 4,000, let's say you have a good month, you're spending only 3,000, then all that $1,000 in extra savings is working for you, knocking down the interest that you're paying. So you could be potentially looking at higher savings in interest cost if you're able to spend less and put more of your income into the Manulife account. So this is the total interest you're paying over the life of the mortgage that you'd be projected to pay it off in 25 years. And that's the total interest you're expected to pay with the 3.94%. So pretty powerful there. I would say and with Manulife One, the benefits of the main account is combines your HELOC, checking and savings account all in one. The interest rate is higher at 5.45%. And this is going to be the same for the RBC and our Citadel HELOC rates. All the deposits, every time you make a deposit, it reduces your principal balance and savings of 107,000 in interest cost. Now, we're able to set up sub accounts. We have to set up a sub account with a minimum of around 100,000 fixed portion. So this interest rate of 4.44 is something we can lock in for a 3-year fixed, and your monthly payment is 550. Obviously, if you wanted to convert more of the main account balance to the sub account with the lower interest rate, we can definitely do that, and that will just increase your fixed monthly payments. I'd be happy to go over some strategies for you if you wanted to allocate more than 100,000 into the traditional conventional part of the mortgage So the sub account here is just like the how the regular mortgage work with a fixed monthly payment or biweekly payment or semi-monthly or a weekly payment. You have the option of setting that up, and the interest rate is 4.44. Now, once we submit to the lender, I might have room for further buy down, but I won't know for sure until we actually submit it. So I do need to get your confirmation if you want to try out with Manulife to see what's the best rate we can knock this down further for you. And again, the major factor is flexibility with the Manulife one, because at minimum, you only need to make $550 compared to 3564 if you went with RBC. So we could potentially free up $3,000 in your monthly expenses. Now, obviously, if you wanted to pay down your mortgage balance just as fast as RBC, obviously you would just stick to not spending all that $3,000. But if you're just if you went with Manulife One, and you're not actually spending, sorry, let me go back to that screen previous. So if you're not actually spending the $3,000, you're just you make your normal deposits, right? All that money that you deposited into the account, it's working for you, knocking down the interest. I'm talking about when I say free up $3,000 in expenses, what I mean is you don't want to think of it as a way to, oh, now I can spend 3,000 extra per month. That's not really what I mean, because if you do that, if you do spend that extra 3,000 a month towards something else for your personal use or whatever it is, then you're not paying down the mortgage balance like you were supposed to in the timeline, and it could take longer for you to if this is if you go on for many months, let's say, without paying extra, you're only making 550 for several months and you're not making extra, you're not keeping extra money in your main account, then your amortization could be stretched longer. That's essentially what I mean. But if you're just living your life as usual, right? You're spending like how you normally would spend, and then you don't have to worry about mortgage payments because all the deposits that you make, right, it's essentially already working for you in paying down the principal balance. So by the end of the mortgage term, you might actually pay off the mortgage faster without realizing it, without doing anything additionally. So that's what I wanted to bring to your attention. It's if you choose to, you can pay down the mortgage faster, sometimes without knowing that, oh, there's only less than $100,000 left to pay. It comes to a surprise a lot of the times. And the benefit also is you can access the equity of your home whenever you need to. There's no need to make a request to get more equity or to make a cash out second mortgage and anything like that. That's the beauty of this is you never have to make another request. It's already there whenever you need to. And let's take a look at the options with RBC compared to what we can get you. Obviously, RBC is 1 year more, so when you're looking at the balance, it's gonna be a lot less than the balance remaining for our 3 year term because you're taking 1 more year to pay off the mortgage, right? So we're looking at the main thing we should be looking at is the monthly payment. You're gonna be saving a little bit less than $20 a month by going with their 3.94%. I believe 3.99 is probably the lowest we can get in the broker channel. So that's that. If I'm just simply competing against rates, then obviously I don't have an advantage there. So that's what I wanted to show you. Like I said, if we're just competing against rates, I probably come out as a loser every time. But the type of value I try to bring to you is my expertise and my access to the various programs that allows you to have more flexibility. You decide how fast you want to pay down the mortgage, how much you want to make payments for the mortgage, right? When you set up a fixed payment, there's no flexibility. It's a fixed amount, $3,500 each month. No negotiation. There's no if something were to happen, there's no insurance. Then you're bound to obligated to pay for those 3,500. But with the Manulife One, right, you have the insurance that, hey, if a rainy, if something were to happen, or if you need access to cash, if for whatever reason cannot make a full payment for a month or two, that's no problem. You're not gonna be penalized. You're not gonna take a hit in the credit score. You're not gonna run into issues with a foreclosure or whatever it is. And also looking at a financial point of view, if you're trying to save on interest payment, interest costs for the mortgage, then it's a no-brainer. The Manulife One can be the most advantageous in that department as well. If your goal is to save, whether your goal is to save on your monthly cash flow or to reduce the total interest payments you're paying, so the total interest cost to you. The Manulife One comes out to be a big winner that way. Now, the key is you have to be a saver and not a spender. So this, I think it comes down to your choice, your lifestyle choice. I think you're a saver. I think based on the equity of your home and the type of investments that you have saved up, I think you're definitely more a saver rather than a big spender. So this could be a program that's worked very well for you. Let me know what you think. We'll connect from there.